Hey guys, welcome to the weekly strategy session for Optionfinity, September 27th, 2020. Hope you all had a great week. Usual disclaimer, everything discussed is for educational purposes only. Do your own research and your own due diligence. The key economic events for the week ahead. Monday, there's nothing at all. Tuesday, 8:30 a.m., Advanced Trading Goods. 9 a.m., Case-Shiller National Home Price Index. 10 a.m., Consumer Confidence Index. On Wednesday, we have some big numbers. The 8:15 a.m. ADP employment report is one to look at for sure. So keep your eyes open Wednesday at 8:15 a.m. because that should move the market. 8:30, we have the GDP revision. 9:45, we have Chicago PMI. 10 a.m., we have the pending home sales index. Thursday, we have a smorgasbord of information as well. We have initial jobless claims, regular state SA, initial jobless claims total, continuing jobless claims, and both regular and total. We have personal income and consumer spending, and also core inflation. And then at 9:45, we have the market manufacturing index. 10 a.m. ISM manufacturing index, construction spending, and then the motor vehicle sales will vary as well. Friday, we have more important information, non-farm payrolls. Previous, we had 1.371 million. Unemployment rate, average hourly earnings, consumer sentiment index at 10 a.m. And then we have factory orders at 10 a.m. as well. Below, you can see the total non-farm private payroll employment data. And yeah, so Wednesday for ADP and Friday for the non-farm payrolls. Those will be two important data points for the week ahead. Keep an eye on those and stay frosty because you can expect a lot more volatility. Keep in mind as well that October 2nd, or next Saturday, October 3rd, is 1 month from the election date in the US. So expect a large uptick in volatility as we approach that date, probably more than we've already seen. I've discussed that in the past. Keep an eye on the VIX and obviously manage your risk accordingly based on implied volatility, right? As many of you saw, I'm sure, Microsoft acquired Zenimax Media for $7.5 billion on Monday, and that is a pretty big deal because both them and Sony are launching their new consoles in November. So with the acquisition, Microsoft acquires a large library of A-list gaming franchises, including Elder Scrolls, Fallout, Quake, Doom, and Wolfenstein. Those are some big titles. And why does this matter, right? Well, as I just mentioned, PS5 launches November 12th. The Xbox Series X and Series S launch on November the 10th. And the Xbox Game Pass will be a large recurring revenue generator for Microsoft. And with the acquisition of ZeniMax, they could make all these titles exclusive to Xbox, which would possibly sway customers to switch from PS5 to Xbox Series S, or sorry, S or X, right? Either one of those, probably the X because it's more powerful. But so last year in Q4, gaming revenues for Microsoft were down to $3.4 billion, down 21% year over year. And according to Fortune Business Insights, gaming consoles market will reach 51.15 billion by 2027. So in just roughly about 6 years or so. And this is important because these acquisitions that Microsoft is making, you know, they bought Minecraft already a while ago, but now having this library of games that may be exclusive to their console could really drive a lot of people to purchase the Series X instead of buying the PS5, right? And why is this important overall, right? It won't move the needle right now, but looking at the numbers, if you look at Microsoft's net income by year, you can see just how much it's risen in the last 2 years. That massive growth right there from 2018 at 16.57 billion, 2019, 39.24 billion, followed by 44.28 billion. That is astronomical growth for Microsoft, right? For a company that big to grow that fast is insane. And they have their cloud business with Azure, right? And if they couple that with the Game Pass and Microsoft and their library of games, they can really do a lot of damage in this industry, right? You look at their current revenue breakdowns by segment, you can see to the right of the screen, the gray area denotes personal computing revenues. The navy blue area denotes the cloud revenues, and the blue area denotes productivity and business processes. So, their Office 365 suite, for example, right? Those are the three segments right now that are enormous. You can see how fast their cloud area is growing year over year, right? But add to this possibly enormous growth in the gaming sector, and you may have a fourth large segment for them to grow, which is why I think they could be the largest company in the world very, very soon, overtaking Apple. We'll discuss some trade ideas toward the end of the session, but I just thought it was interesting to see what they're doing with their cash right now, and also to think about that allocation of capital, right? Because cash right now is so cheap that they're able to take that cash, borrow money from the market, right, by issuing debt at very low rates, and acquire assets that could provide them with enormous returns, right? That is very, very smart capital efficiency, right? So think about that for a little bit. We'll go through our usual segments before we discuss a idea on Microsoft as well. So here's a little bit of TA on them as well. They have heavy support at 195, and you can see the 200-day EMA is right around 185. This will be important for the end of the lesson right now. So earning reports for the week ahead. We have tomorrow, Thor Industries reporting before open. They're the maker of Airstream trailers, and I expect them to do pretty well given that no one's traveling right now, so they're probably out in RVs traveling around, and they had some decent growth last year as well. Micron reports on Tuesday after market close. That is one to watch for sure because they had some revisions to their guidance in the past quarter, and their CFO spoke at a conference, and he didn't sound very optimistic about their prospects. So they fell down from about 54-ish down to about 42 area, and they bounced back up. Now they're at around 48. So you can expect some volatility there. I'll be watching that report after hours. And then we have on Thursday before open, PepsiCo and Bed Bath & Beyond. Those are two ones to look at, right? And also Constellation Brands, which is the alcohol and beverage provider that sells Corona among other different beverages, right? So not a lot going on this week, but there are a few big names here too. Weekly analysis for the SPY. Current price is $328.74. The EM for the week is $7.70 or 2.3%. The PM for the week is $10.58 or 3.2%. The upper move for the week is 339.32, and the lower move is 318.16. So you can see on the chart as well that blue line right there denotes the 200 EMA, and we're not too far from it. It's right around 314. So we got to 320, actually below 320 this week. We went below it temporarily and bounced back up. So keep an eye on that. If we break below that, that could signal some serious selling ahead, right? And also don't discount the election coming up, which is about a month away. Secondly, we have the analysis of the triple Q ETF for the NASDAQ 100 index, right? Current price, $271.74. The EM for the week, $8.64 or 3.2%. The PM for the week, $11.56 or 4.3%. The upper move for the week is 283.30, and the lower move for the week is 260.18. Looking at the chart below, you can see the EMA, the 200 EMA right there, right around 240. So we're still a ways above that right now. But again, we've seen some serious volatility, and tech is still very frothy. So if we do get some serious selling in the market, you can see us push toward that area again, although I doubt we'll hit that level by the election. The Russell 2000 ETF, IWM, has been very weak, actually. And we'll go over the weekly moves right now first. So the current price, 146.20. EM for the week, 503, or 3.4%. The PM for the week, 673, or 4.6%. The upper move is 152.93, and the lower move is 139.47. So you can see that we're actually below the 200 EMA right now, which is pretty dangerous or precarious territory for the IWM ETF. So I mentioned, I think last week or the week before, that if it broke below 150 and remained there for a while, we could see some serious downside, because these are the small cap stocks that are going to be hurting the most due to the coronavirus, not the large mega cap stocks like Apple, Microsoft, Amazon, etc. Those are fine. The small caps are going to be hurt the most, right? So keep an eye on this, because if we keep breaking down, we could easily break down to the 125 level, which is a pretty significant drop, right? And you can use put spreads, given the elevated implied volatility, to benefit off of that move should it occur, right? Ticker analysis from last week. Thank you very much again to Frank for doing this great work. So we had 7 out of 31 stocks close inside of the PM. We had 7 out of 31 stocks breach the PM temporarily, yet closing inside the range. And we had 21 out of 31 stocks closing green on the week, right? So you can see last week we had Costco ER and Nike ER. They both breached and they closed inside the range, right? So Nike breached, closed inside of it, and Costco did not breach at all. So if you played the Iron Condors using the potential moves as your barometers, you would have won nicely, right? For the week ahead, we have, again, 1 ER on the ticker analysis. We have Micron. So closing price on Friday was 49.14. The EM, $3.74, or 7.6%. The upper EM is 52.88. The lower EM is 45.40. The PM for the week is 509, or 10.4%. The upper move is 54.23, and the lower move is 44.05. So keep an eye on these numbers as you make your trades on the week, because they are good to use as guidelines as to when to enter or exit trades. Trade idea for the week is a put ratio spread on Microsoft. As I mentioned earlier, I am very bullish on them, and I do like their prospects going forward as one of the largest companies in the world. I do think they will overtake Apple at some point and actually become the largest company in the world, because they are growing at an astronomical clip right now for such a large company, right? So given the implied volatility is still elevated somewhat for November due to the election, I like to use the put ratio spread, which I'll discuss in 1 second, as a trade idea. You can see the IV curve over here. So the position would be to purchase one of the November monthly contracts, which expires November 20th, 190 strike puts, and then sell 2 of the November 20th expiration 175 strike puts. So this trade would cost net at the current midpoint 20 cents per position, or $20, right? Because it's 100 contracts, or 100 shares per contract, right? The break-even price would be your long strike of 190 less your debit amount of 20 cents, thus 189.80. Your second break-even strike would be 175 less 1480, which is 160.20, right? So because you're doing a put ratio spread, your long 1 put, your short 2 puts, you have 2 break-even prices, right? You have your upper break-even price and your lower break-even price in the event that it breaches the 2 short strike puts, right? Because keep in mind, you do have downside exposure on that second naked put, right? The maximum profit on this trade is found by taking our long strike minus our middle strike, 190 minus 175, minus our debit amount of 20 cents. Thus, it is $14.80 possible max profit for 20 cents risk. This offers you a possible profit of 7,400%, but do not expect to achieve that, because that would require Microsoft to close right on the nose at 175 at expiration. But it does have a lot of upside given the small amount of risk. This is the epitome of asymmetry of risk, especially if you don't mind owning Microsoft stock at a much lower price, right? So your maximum risk would be your second break even of 160.20, right? Minus 0, which would mean you'd be risking $16,020 if Microsoft were to go to zero, which is very improbable. I'm going to say impossible, right? The genesis of this trade is that you would be happy to own Microsoft stock at 160.20 if it managed to drop that low. However, the trade has enormous profit potential on its own, right? So you can profit off the trade itself. If we're to move to, for example, 185, you're still making $5 net on 20 cents risk. So you're making what, 2,400% return. Sorry, no, that's yeah, 2,400% return on 20 cents risk, right? Which is enormous, right? Because you can make $480 off $20 per contract. Keep in mind the collateral required for this trade due to margin requirements would be roughly $3,300 depending on the broker that you're using. I know that Interactive Brokers right now has raised their margin requirements due to the election-induced volatility, right? So again, you're short one put net of your put spread, which is why you require margin in this position, right? And then obviously, if you wanted to buy Microsoft stock at 160.20, then you'd be required to have $16,020 in your account in order to purchase 100 shares if it was to be assigned, right? So this trade, you know, even though it may have a low probability of playing out in terms of being assigned, it does have a decent probability of playing out in terms of generating a profit, because what happens is that the way that the Greeks work in this trade benefits the owner of the put ratio spread, because if it drops down even a little bit with a time decay in the middle strike, what would happen is that at a certain point in time, you'd be able to buy back your middle strikes for a profit and hold your long position possibly for a small debit as well, right? Keep in mind that whatever you purchase back your short strikes for, you need to add that onto your overall risk of your position. So for example, if they go to 10 cents each and you buy them back for that amount each, you would add 20 cents net to your position of risk. So your position risk would go from 20 cents to 40 cents, right? And that is the idea for the week. Here's a little breakdown of it visually, right? So you can see on the chart that the 190 strike is, you know, far below support of 195 right now. But if we were to break down there, your maximum profit occurs at 175, and your second break even occurs at 160.20, right down over here. Again, you're long 190 strike put option. You're short the 175 put times 2. And so that's why you have two different break-even points, right? You have a put spread plus an additional put right over here. And essentially what happens is that if you hit max profit over here and it goes down over to here, this max profit covers this maximum loss in this area, right? That's why your break-even is down over here. And then again, you'd own the stock at 160.20, which isn't too shabby because it isn't that far off those March lows from the earlier dip in the year, right? So again, just for some food for thought, guys. Again, you know, make sure you do your own due diligence on these trades. Understand what you're actually doing. Don't take my word for it, because again, I'm just trying to educate you and help you understand what is possible and help you to think outside the box a little bit, right? Using options, because options give you options, right? That's what I always say. So look at the IV, look at your risk tolerance and your portfolio overall, and see if it fits into your risk tolerance criteria for your portfolio. And yeah, that's pretty much it for the week. If you have any questions about this at all, feel free to email me at nick@optionfinity.com, and also visit the website as well. And if you did like the video, if you found value in it, please like and subscribe and share with other people as well. Thank you very much for your time, and have a great day. And I'll see you guys next Sunday as well.